You have a rising cost of capital right now. So from that perspective, all companies are forced to rationalize and rethink their business models. And tech obviously has had an enormous period of growth. And with that growth, you're making essentially investments into optionalities. And the problem is these optionalities get more expensive right now. And the market has already derated these optionalities last year, so unprofitable tech. But there's a lot of type of businesses embedded within big tech companies, which are ultimately conglomerates that are trying to combine conglomeration and innovation. And in these type of phases of higher cost of capital, it just means that some of the optionalities they have, they need to potentially put on ice. And that means that there's potentially layoffs and cost cuts to protect margin. And that could make them actually, in a cyclical slowdown, very interesting restructuring place. But it's very much a stock picker story. So it depends a bit on execution.
And is it a stock story or is it a credit story? Is it a debt story?
Very interesting. I mean, as you know, the tech doesn't have that much debt in the sense that these balance sheets are often quite underlevered. So I would say it has to be an equity story, which maybe explains why people go there right now, because that's the only way to play it.
You work at a bank that loves unlocking sum of parts, the whole intrinsic value model, and we've been talking about Alibaba all week. Is there a read across for Wall Street, for NASDAQ-listed companies, where they follow the Alibaba model? And we've been thinking about these huge plays where there's been a little bit of pushback already from regulators about technology companies being too big, too dominant in society. Maybe they need to shrink from here. Do you see that being a play as we talk about technology, that there could be unlocking sum of parts stories stateside in big listed FANG stocks?
I think 100%. If you think about the typical late cycle template, think about 2005 to 7, you had a major LBO boom. And we cannot have that because the cost of capital is much higher, the leverage is much more constrained. But ultimately, late cycle, you always see a pickup in restructuring. And the reason is for obvious reasons. The top line doesn't have the boost anymore, and the bottom line might suffer from inflation pressures, margin pressures. This is a typical late cycle phenomenon. So the best thing you can do as a company is restructure, unlock value in other ways, and that includes spin-offs, getting rid of non-core businesses, refocusing. And I think there will be much more of that. And I think that the high cost of capital is a very powerful force to kind of get investors and management focused on that.
Are the banks on the naughty step for some time to come now until we understand what the structural consequences are of this adjustment in interest rates? I mean, We've seen this remarkable deposit flight take place, and it's been liquidity rather than insolvency that I think the market is worried about at this point. I mean, have you found a reason to want to own a bank at the moment?
I mean, they're very profitable. And as of now, they pay very high dividends.
Yeah,
and
they've got unrealised loan losses. They've got unrealised portfolio losses on their bond books. I mean, these chickens come home to roost, right?
I think you're answering the question yourself. I think the problem with banks is it's their confidence game. And I think the confidence has now been lost because of plumbing issues. There's been the digital age of deposit flights. There has been generally punishment for banks that have issues in a very violent way, which markets in hindsight really struggle to understand how the Credit Suisse thing unfolded, how to some extent even the movements in Deutsche Bank unfolded. So there's a certain level of discomfort which will take time to dispel. And you're absolutely right, we are still going into a slowdown. We haven't even seen the cash flow impairment. We haven't even seen the solvency risk. So as a result of that, as investors, you ask for a higher required return. The cost of capital goes up. We see that across the capital structure, credit, AT1s, equity. And I think the question really is, in the next few weeks and months, how the banks will deal with that. There's a very good chance that you have a bit more regulatory response, which will take systemic risk down, that can support the sector in the near term. But there is a big question mark on duration transformation. These are borrow short, lend long businesses, and the yield curve is deeply inverted. The cost of capital in the front end is very high. How is that going to affect profitability at a time where growth is slowing?